In October 2025, Bitcoin shattered every logical boundary. It planted a historic flag at $126,000, a figure that at the time even AI believed was only the beginning. The euphoria then spread everywhere. Walk into any coffee shop, and you would hear people discussing enormous profits. The atmosphere was extremely vibrant, almost impossible to contain. But what about now? The mood is chillingly bleak. The price is struggling in the $60,000 to $70,000 range, meaning it has nearly been cut in half from its peak, almost split in two. And today, we are talking about market psychology, as well as on-chain data analysis. That is data extracted directly from transactions on the blockchain in early 2026. Numbers that do not lie. The mission of today's deep dive is to dissect a vital question. Are these consecutive months submerged in red the end of a cycle? Or is this in fact merely a brutal test, a necessary purge, before the entire market ascends to a completely new valuation tier? This is a very big question. What makes it compelling is that these sources do not care about hollow speculation on social media. They go straight to the core, ignoring all the shouting. They do not merely look at the flashing green and red lines on price charts. Instead, on-chain data shines a direct light on human panic psychology and the movement of enormous capital flows. Movements that are silent, invisible, yet destructive. We are standing before a lens where mathematics, behavioral psychology, and macroeconomics intersect, forming an extremely complex picture. And when looking at the surface of the current panic, the numbers truly make one hold their breath. I am referring to the percentage of supply and loss. As of this moment, nearly 46% of the total circulating supply, approximately 9.31 million Bitcoin, is underwater. Meaning investors are holding unrealized losses, nearly 46%. An enormous figure. But it does not stop there. The report records that in just a single short hour, when the price slightly dipped below the $65,000 mark, as much as $230 million in long positions were liquidated entirely. Just a slight drop, $230 million wiped out. And to clarify, long liquidation means that investors borrowed money from exchanges, used leverage to bet that the price would rise. But when the price falls below a certain threshold, the exchange automatically triggers forced selling to recover the funds. And everything is wiped out in an instant. And so, the entire wealth of those people evaporated. Across the forums at this moment, people are whispering to one another that the market is being haunted by a ghost called the $35,000 level. It truly feels as if doomsday is drawing very near. The atmosphere is suffocating to the point of breathlessness. But what matters more is that the psychology behind those bloody liquidations is what is truly shaping the current market structure. When nearly half of the market has to endure losses that erode accounts day after day, the story is no longer about what the intrinsic value of the asset actually is. It turns into a psychological torture game. Deep analytical documents call this phenomenon Phase 4 of the bear market. And here lies a core paradox that must be dissected. Phase 4 is nothing like what people imagine. It is not a sudden collapse, not a noisy flash crash, nor a chain reaction of lending institution failures like in 2022. It is far more dangerous because it is a slow erosion. A sharp crash can cause temporary panic, but it is the prolonged sideways movement, lasting for months, that becomes the real blade. Each day, the account shrinks a little. Each day, you wake up to yet another piece of bad news. It does not kill instantly. It kills your belief in the market. And the current market has been split in two with a very clear boundary. On one side are those fidgeting at every price candle, panicking whenever they see red. On the other side are forces looking at the fixed finite supply foundation. They quietly cast their nets, waiting for the golden opportunity to accumulate. And this is where it becomes truly interesting. Set emotions aside for a moment, let the cold numbers speak. When turning to on-chain data analysis, reports the polarization between these two groups becomes unmistakably clear. The data shows that the short-term holders, meaning those who bought within roughly the past half year, including traditional whales who newly entered the market through massive ETFs during last year's late frenzy, bought at the peak of euphoria. At present, this group has an average cost basis as high as $89,806. That means they are carrying losses of around 25 to 30%. In other words, for every 100 units invested, only about 70 remain. A very painful feeling. In complete contrast, on the other end of the battlefield stand the long-term holders, LTH, those who embraced this asset before it became a hot topic. They have an average cost basis of only around $40,909, less than half that of the short-term group. That means no matter how desperately the market outside may be screaming, this group is still sleeping soundly with unrealized profits of more than 60%. A complete opposition. But wait, if one group is panicking, fleeing, and cutting losses, then who is stepping in to absorb all that selling pressure? Why does the price not plunge straight into the abyss? If we place this question within the broader picture, that absorption mechanism reveals itself in a very logical way. Enormous pressure is bearing down on the shoulders of investors who chased the euphoria, those who entered the market with hopes of getting rich quickly. They can no longer withstand the heat. And according to the historical data of every previous cycle, a truly solid bottom is only formed when a phenomenon called absolute capitulation occurs. Technically, that is the moment when the death cross appears, meaning when the cost basis of the short-term holder group falls straight below the cost basis of the long-term holder group. But as of February 2026, that signal has still not officially appeared. It has not appeared. However, what is most noteworthy lies with the long-term holders. They are not shaken by macro news or price declines. They are not selling. On the contrary, on-chain data shows that they are still quietly accumulating more. Experts refer to this process with a term that sounds elegant, yet is utterly brutal: conviction transfer. Capital flows and the finite asset supply are systematically and relentlessly shifting. From weak, impatient hands, those unable to endure the searing pressure of Phase 4, into the pockets of institutions, hedge funds, and individuals who have mapped out a vision for the next decade. It is a large-scale wealth transfer, and merely thinking about it is enough to cause goosebumps. But the story does not end there. It leads us to a larger issue: the global economic landscape. Why have there been 5 consecutive red monthly candles? This is an extremely rare phenomenon in the history of this asset. 5 straight months. Is the macro picture truly on the brink? The news is saturated with geopolitical tensions, escalating new tariff policies, record-high consumer debt. All of it creates the impression that the foundation of the global economy is cracking, like a massive stone tied to the market's leg, dragging it downward. The analytical data delves deeply into a significant event. The Federal Reserve, the Fed, suddenly slammed on the brakes. They halted the entire rate cut path that the market had expected and fixed interest rates at the 3.5% to 3.75% range in January 2026. That was a bucket of cold water poured directly onto risk assets. But viewed objectively, this macro event, together with tariff policy, is in fact merely a catalyst. They create a seasonal risk-off environment, capital temporarily seeking refuge in government bonds or cash. Yet the larger picture, what the on-chain data analysis wants us to see, is this: the market participant structure has completely changed. Everything has changed from the root. Forget the context of 2014 or 2018, a period when the market resembled a Wild West casino, driven and capable of collapsing solely because of the panic psychology of retail investors recklessly borrowing leverage. The context of 2026 is completely different. The market has been institutionalized to an extremely deep degree. At present, we are witnessing the existence of massive ETFs on Wall Street, with total assets under management exceeding $100 billion. This volume of capital acts as an armored liquidity cushion, making declines triggered by macro news no longer as destructive as before. Instead, they resemble portfolio adjustments more than anything else. External systemic instability does not collapse the core foundation of this asset class. It merely uses it as a pretext to shake out weak-handed holders from the game. To demonstrate the depth of this institutionalization, the report provides a very vivid example: Harvard University, specifically HMC, the management company overseeing the endowment fund of this prestigious university. They do not participate in the market as a trend, nor do they allocate a small amount of spare cash for amusement. The data shows that they have seriously allocated 0.84% of their enormous total assets under management into a Bitcoin ETF. 0.84% of a large university endowment is by no means a small figure. But the more striking detail lies in the fourth quarter of 2025. They executed a portfolio rotation, withdrawing 21% of their Bitcoin position, equivalent to approximately $86.8 million, to shift into an Ethereum ETF. A highly notable move. An academic fund like Harvard also rotating from one coin to another, does that contradict the buy and hold to the end philosophy of pure believers? Or is this action signaling something else? This is precisely the boundary between the mindset of a gambler and the mindset of financial elites. The rotation of $86, $8 million, is not short-term opportunistic trading. It reflects a generational shift, a shift in valuation methodology, a shift in the perception of digital assets. Digital assets are now classified and actively managed by traditional finance. They are viewed as a core asset type, a digital asset class. No longer a lottery of chance. No longer a solitary speculative asset drifting at the fringes of the global financial system. The fact that large institutions conduct periodic portfolio rebalancing, taking partial profits in one asset to allocate into another with better growth potential, demonstrates the remarkable maturation of market infrastructure. They act based on strategically programmed allocation weights embedded in risk management frameworks, not on fear when the market crashes, nor on greed when the market peaks. And as the gaps in perception regulation and valuation gradually narrow, as smart capital views this as an asset capable of sitting in the same basket as technology stocks or gold, the market's reaction mechanism to shocks will change permanently. So what does all of this data mean? What would happen if the darkest ghost truly appeared? I am referring to the Black Swan scenario, a life-or-death test known as the $35,000 price level, a figure that haunts forums everywhere. If those liquidity cushions are no longer strong enough to hold, if the price plunges straight down to $35,000, how devastating would the chain reaction be? If that scenario were actually triggered, the first thing we must do is not panic, but dissect its real consequences across the entire ecosystem. Who would fall first? The group that would take the fatal blow would be the miners, the backbone that maintains the security of the entire network. After the recent halving cycle, when rewards were cut in half, their profit margins have become razor thin. Data estimates that the average break-even threshold of the mining industry now stands at around $37,800. That means if the price drops to $35,000, they would be mining at a heavy loss. In February alone, algorithmic difficulty has already dropped sharply by 11.16%. A clear signal that some mining operations can no longer bear electricity costs and have quietly pulled the plug. Imagine it like a breath-holding contest. Underwater small-scale miners using outdated machines and paying high electricity costs are like those with smaller lungs. They will have to surface first. If the price breaks through $35,000, a wave of mining operations would be forced to shut down to avoid bankruptcy. And after that seismic shock, what inevitably follows is a concentration of power. Mining and transaction processing authority would fall into the hands of a few massive corporations, those with abundant capital reserves and the ability to negotiate extremely low electricity prices, such as Marathon Digital Holdings or Foundry USA, a scenario of big fish swallowing small fish. And when speaking of big fish, we cannot ignore another giant force, MicroStrategy. Current reports indicate that they are holding 717,000 Bitcoin with an average cost basis of around $76,000, an enormous figure. If the price were to fall to $35,000, their portfolio would nearly be cut in half in value. Many fear that this company would face a margin call, creditors demanding additional collateral and forcing asset liquidation, triggering a cascading collapse across the entire market. But here, a common misunderstanding must be clarified. MicroStrategy's risk is real, but it does not lie in an immediate margin call on exchanges. The majority of their multi-billion-dollar debt structure is not directly collateralized by the Bitcoin they hold. So, where is the real ticking time bomb? It lies in the future, specifically in the refinancing risk of massive convertible bond tranches that will begin maturing in the 2027 to 2028 period. That is the point that must be monitored. To put it simply, when issuing convertible bonds, the company promises creditors that at maturity they can choose to receive cash back or convert into company shares at a preferential price. It sounds appealing, mutually beneficial. But the problem lies here. If MicroStrategy's stock price free falls alongside the underlying asset dropping to $35,000, what happens? The investment funds holding the bonds would have no incentive to convert into equity. They would turn their backs on the conversion option, refuse to take that stack of paper, and demand cash instead. And when a wave of creditors all want hard cash at the same time, liquidity pressure would weigh heavily on the company's balance sheet. That is the real point of tension. And that is not all. From a technical on-chain perspective, the current 60,000 to 62,000 range resembles a fire ant nest, densely packed with massive leverage clusters with numerous borrowed positions stacked on top of one another. Therefore, if the $35,000 level were to occur, it would be like a decisive slash, wiping out the entire excess and toxic leverage system. It would be extremely painful for those who have borrowed beyond their limits. But it must be emphasized once again, that does not mean the entire system collapses. Thanks to the solid institutional cushion provided by the ETFs we analyzed earlier, the market is no longer as fragile as in previous cycles. If $35,000 were to appear, it would resemble a stress test, the greatest endurance test of the decade. And here arises a very interesting paradox. If the long-term potential truly points toward $1 million over the next 10 years, as many prominent minds believe, then why can it not rise calmly? Why not move upward steadily like a beautiful diagonal line? Why must we repeatedly endure fiery red periods, brutal purges, moments when accounts are torn apart? The answer is very simple, but not easy to accept. People always want large rewards without bearing risk. But financial markets do not operate according to that desire. The market has an iron rule: it never pays for comfort. It only pays for vision and conviction. Extreme volatility is not a flaw of the system. It is its core feature. Look back at history in the dot-com era. Amazon's stock once evaporated by 94%. 94%. Those who held on must have endured terrifying psychological torture. Or gold, the world's ultimate safe haven asset in the 1970s, just before surging from $35 to $850 per ounce gold, once declined by as much as 45%. Those drawdowns were not accidents. They were part of the journey. And if we observe macro data, we see something important. Bitcoin's volatility amplitude is in fact gradually decreasing over time. In previous cycles, it fluctuated 6 times more than the S&P 500 index. But by early 2026, that figure has narrowed to only about 1.2 times. That indicates the market structure is maturing. Yet even as volatility declines, the essence remains the same. Non-linear returns always demand a commensurate price. And that price in financial markets is often paid in blood and tears. Without that ultimate pain, without this brutal process of selection, digital assets would merely shrink into an ordinary financial instrument. They would hover at annual returns of 7 to 10%, like a pension fund, stable safe, but not transformative. And if that were the case, they would never be able to become an asset class powerful enough to alter the structure of global finance. Because volatility is the most natural filter. It eliminates complacent expectations. It washes out weak capital flows. Now let us summarize. If someone listening to this podcast is staring at a portfolio glowing red, what is the most important takeaway? It is this: the fiery, psychologically torturous months of early 2026 are not a death knell. On the contrary, they are a necessary biological purification process, a painful yet vital transformation. This asset class is attempting to shed its skin. It is stripping away the image of a newly emerged high-risk, easily evaporating asset to move toward the status of a foundational asset, an indispensable pillar in the portfolios of modern elites. The harshness, the price whipsaws, the intense volatility, all of it resembles a ruthless funnel. It strips wealth from those with false conviction and clears the path for massive long-term constructive capital flows. But before closing, there is an unavoidable question, a paradox embedded directly within the on-chain data divergence. Everything seems perfectly programmed for an elite Wall Street breakout. Institutional capital is pouring in forcefully. Yet, system data points in the opposite direction. The number of truly active wallet addresses on the network has fallen to its lowest level in 5 years. Pause and think carefully about that. While billions of dollars continue to surge in through ETFs on the stock market, actual grassroots user activity is declining. So what is the question? Is all the glamour of traditional finance, the polished suits, masking a hollow market? A network lacking real base layer activity? If a new super growth cycle truly unfolds, will it merely be a derivatives-driven financial game, a mechanical loop where large institutions trade back and forth among themselves? Or must it be nourished by genuine utility by tens of millions of end users worldwide? A trillion-dollar network devoid of real user participation? That is the haunting question. Does true value come from the endorsement of massive financial institutions, or from the everyday transactions of people on the network itself? This is not merely a technical question. It is a foundational equation. And anyone allocating capital placing conviction in this market must find their own answer before dreaming of the next profit horizons. And perhaps that is also the most profound closing point for today's analysis.